Hey guys, Frugal Samurai here. Welcome again to my channel. So in today's video, we'll be talking about one of the most common questions asked in investing, and that is, what should I buy, either property or shares? So in this video, we'll be going through the pros and cons of each and also to determine which one is most suitable for you. So let's begin. So first off is shares. Now most people are familiar with shares. You find a company and you buy the shares of that company based on its future prospects. Or you look at buying into an exchange traded fund, or what's commonly known as an ETF, that tracks the market index, and put your money into it. So let's take a look at the pros of buying shares. Liquidity. So shares and ETFs are actually quite liquid in the fact that you can buy and sell when you need to. Accessibility. It is also quite easy to transact and there are low entry and exit costs. Affordability. So typically you can buy shares and ETFs from a very low starting base, even for a few $100s. Passive. Shares and ETFs are also quite passive in that it doesn't take a lot of time nor effort to maintain your portfolio. Diversification. It's also quite easy to achieve diversification across your holdings by not putting all your eggs in one basket. So those are the pros, but what about the cons? Well, the cons are volatility. As we've seen in the last few months, share prices can fluctuate substantially in a short period of time. Capital loss. You can also lose your money if the company that you invest in goes bankrupt, or if the underlying value of the ETF plummets in value. What you see is what you get. Unlike property, you can't actually control nor add value to your share or ETF. Less and more costly leverage. So typically if you wanted to borrow against the value of your shares, say in the form of a margin loan, you would need to pay a high interest rate than if you wanted to borrow a mortgage, for example. Also, the loan to value ratio is usually lower than if you wanted to buy a property. Don't forget that you also run the risk of margin calls, in which case you need to tip more money in if the value of your share portfolio drops in value. Now let's take a look at property. As Aussies, we have this cultural obsession with the housing market. This has fueled the largest asset class in Australia, with the total value of housing in excess of $6 trillion. Compare that with the share market, which has a market value of just under $2 trillion. Therefore, it is safe to assume that most of us are familiar with property either as owners or as renters. But what about investing in property? So let's take a look at the pros and cons of each. So the pros of buying property are leverage. The main advantage with property is the fact that you can leverage against your investment. What this means is that typically lenders are willing to lend you more against the value of the property if you wanted to get into the market. Mortgage rates are also very cheap right now. We're seeing owner-occupied rates in the low 2%. But of course, don't forget that leverage does work both ways in that it amplifies both your gains and also your losses. Adding value. Another advantage is the fact that you can add value to your investment either through doing a renovation or by adding a second dwelling. Tax benefits. There are also more tax benefits afforded to property buyers. These can range from things like negative gearing to avoiding to pay stamp duty to not having to pay capital gains tax. As you can see, there are a myriad of tax benefits to the individual buyer depending on their circumstances. Inflation protection. Because property is a tangible asset in that we can see and touch it, it is sometimes referred to as a hedge against inflation. Inflation is the general rise in price of goods and services. So those are the pros of buying property, but what about the cons? Well, the cons of property are more involvement. So typically, as a property investor, you'll need a more hands-on approach to deal with things such as maintenance and other issues. You could of course outsource these to a property manager, but then of course you do need to pay them accordingly. Less affordable. You will also need a higher capital position to get into the property market. For example, if you are a first home buyer in the capital cities of Sydney or Melbourne, you will need at least $100,000 if not more just to buy a median priced home in those capital cities. Not as liquid. It does take longer to buy and sell property, so if you do need money in a hurry, you may be forced to accept a lower sell price. Cash flow dependent. Now most of us do buy property with a mortgage, which means that we are reliant on the cash flow and the rent that comes in to pay off that debt. So now that we've looked at the pros and cons of buying property versus shares, which one is better suited for you? Well, there is no right or wrong answer to this, but it does depend on a number of factors. Factors such as your capital position. So how much money do you have right now to get into the market? Your risk appetite. So these could be things such as, are you willing to cop a short-term hit for a longer-term gain? Your financial goals. So what are your financial goals and when do you expect to achieve them? Diversification. So how comfortable are you with diversification and are you willing to put all your eggs in one basket? And lastly, are you a passive or an active investor? Now, personally, I have invested in both property and shares and I've done quite well from both. But which one would you prefer? Let me know in the comments below. And if you like this channel, hit that subscribe button, click on the bell, turn on notification on, and I will see you guys next time. Bye bye.